If you're a property investor, today's episode's a must. Why? Because the tax man is after you. You and all property investors. It's not long until tax time, and the Australian Taxation Office is already preparing its so-called hit list of priorities, areas it's going to crack down on in the current financial year. Property owners, crypto investors, and those working in the gig economy are going to be in the front of mind for the tax office. And also a number of other areas that we're going to discuss today with Ken Rais. So we're going to look at the list in the hope that you're going to be able to avoid a nasty surprise at tax time. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
The Australian Tax Office might be taking a much closer look at your tax returns this year than you'd like, due to significant increases in the tax office's operating budget, particularly with technology. Property investors are once again in the ATO's sights. Now, I know somebody who's watching this very carefully, and it's Australia's leading property tax strategist, Ken Rais, Director of Metropole Wealth Advisory and one of my business partners. So I'd like to ask how we can protect ourselves and what we should be looking out for. Hi, Ken.
Hi, Michael.
Now, it's not only property-related deductions the tax man is looking at, is it? So I'd like to discuss other areas as well at the moment, like other sorts of investments, other claims, cryptocurrency. But let's start with property, since most of the people listening to this are property investors. What's the tax man watching out for this year?
Look, I think one of the main ones that they've been looking for a while, but they're tightening their noose, is a repair versus an improvement.
Mm-hmm.
So with a repair or a maintenance, you can write that off immediately. Whether as an improvement, you have to depreciate it over the life of what you've done. So there's very strict rules. So a repair just brings it back to its normal condition, where an improvement takes it beyond that. You've got more than that. So you can repair a carpet in one room and it's a repair. But if you replace all the carpets in the unit or the house, that's an improvement.
Sometimes it's really obvious, but other times it's not. So it's actually good to get advice, tax advice on this. Oh, by the way, we probably should start off right at the beginning, Ken, by saying this is not advice. This is general information. Even though you are an accountant and you have got financial planning background and you're a student of economy for years and years, this is basically a general discussion. We have to put that disclaimer in, don't we? Because otherwise somebody's going to say, hey, but he told me so.
Absolutely right. So we don't know everybody's circumstances, and even with what appears to be similar circumstances, it'll go left versus right, depending on very specific circumstances, which is why we say always get the specific advice. So today we're talking general.
Okay. So the first thing is, hey, I'm actually repairing something, but while I'm there, why not put the latest in? Is that really a repair? It's a grey area and you better get advice. What else is the tax man looking at?
I think the other big one is interest expenses.
Mm-hmm.
And I think that falls into a couple of categories. So interest is deductible depending on the purpose of the loan that you borrowed the money for. So if you borrow money to invest and earn income, that's deductible. If you borrow money for personal reasons, that is not deductible. But
so we've said it before, Ken, it's really not the property or the asset you're borrowing against. So even if you borrow against your home, you increase your loan, maybe a separate loan, and it's used for investment purposes or business purposes, income earning purposes, then it's tax deductible.
Correct. So you've got to differentiate between what did you give as security with what did you use the money for.
Yep.
So as you said, you can borrow the money off your home, but you're using it for an investment. And vice versa, of course. If you draw equity down from an investment to renovate your home, that's not deductible.
Makes sense. You really got to document things well then, don't you? And you can't really pull it out of the same bank account where it all gets mingled in.
Correct. And where a lot of people fall foul is they draw money, call it out of their equity of their home, where they use part of the money for improvements on their home and part of the money for the investment. So the ATO says you just got one lump sum of money. How do I know which is which? So we normally tell our clients to get split loans. So you can say this particular drawdown is A, used for my home, and this particular drawdown B is for the investment. And you get two separate statements. Because if you don't do that, your accountant has to do apportionments, and are you paying down principal because interest is calculated daily? So it's a large exercise to do when administratively it could be done a lot easier.
Now, before we get on to some of the other things the taxman's looking at, maybe we should just take a big picture view. They are looking at us more carefully at the moment, aren't they, Ken? How do they do it? What do they do?
So the hundreds of millions of dollars that were invested in the ATO in their IT systems is allowing them to cross reference. And, they get information from the banks, they get information from real estate agents, they get information from insurance companies, they get information from a whole wide range of suppliers, and then they data match. The very big computers that they've been able to buy and the investment in programming allows them to just data match. And that's really been the game changer for the ATO. That's why now you can have a pre-populated tax return with dividends, interest, a whole bunch of things, because that just comes straight through the ATO portal.
Interesting. So no corners to hide in, but not that you should have ever done that anyway. Now, again, there are ways to legally minimise your tax, and I know that's what you and the team at Metropole Wealth Advisory specialise in. But having said that, let's have a bit of a further look before we get on to that and what the taxman is looking at. And I guess one of the other areas he's looking at is when you sell a property, is there capital gains tax? Isn't there? Was it your home for part of the time? That's a common question people ask. It's probably one of the most common questions left on Property Update about capital gains tax obligations.
Yeah, so capital gains tax was introduced on the 20th of September 1985. So any asset bought before that is free of capital gains if you ever sell it, as long as it's the same owner, of course. And any asset post that date, you've got to pay capital gains tax. And normally if you've bought an investment, an asset to keep as an investment, and you've held it more than 12 months, you get the 50% discount. You've got to really look at, when you're looking at the 12 months, the date that you executed the contract, not the date that you settled on.
But of course, Ken, if you purchase the property with the intention of always selling it as a profit, you can't claim the capital gains tax discount, can you? So it all goes back partly to the purpose.
The purpose, correct. So even if you bought a property with the intention to sell it and you kept it for 5 years, it's still not a capital gain which gets the 50% discount. And it's the date of execution of the contracts, not the settlement dates, that they look at the 12 months. And the ATO looks at, is it one day beyond the 12 months? Did you contrive the date type of stuff for tax avoidance?
That some people try to do. But I think there's another big factor that most people miss out on when they sell a property. They're not made aware of it. I'd like you to explain that. That is, okay, each year I claim a depreciation allowance. I claim 20,000 the first year, maybe 18 the next year. And over the first 5 years, I've claimed 50,000 depreciation allowance. What happens to that when I eventually sell the property?
So there's two types of assets that are depreciated: your fixtures and fittings, the carpets and things like that, and the capital works, which is the building. So depending on when you bought the property, you can or can't claim fixtures and fittings, but you can always claim on the building, and normally it's 2.5%. So you've got to add back the amount that you've claimed depreciation on the building, the capital works. So that effectively reduces your purchase price. So if you've made a profit, that increases the profit when you have to add back. And a lot of our clients argue, well, should I claim depreciation in the first place if I've got to add it back? And the answer resoundingly is yes, 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 because you're claiming the depreciation at your full marginal tax rates. And then if you've got to pay some of it back, it's with a 50% discount. So, and you don't know that you're going to sell. So claim the depreciation while you can.
That makes sense. Now, another area that I know the taxman's looking at is holiday homes, use of holiday homes. I know a lot of people over the last couple of years when they couldn't go overseas have bought a holiday home. Sometimes they use it as an investment. Part of the time they have it on Airbnb or other things. How does all that work?
So if it's an investment property, then it's an investment. But what you've got to do is carve out any time that you use that property or that the property is not available for rent, because then that proportion of all the expenses, interest, council rates, repairs and maintenance, et cetera, is not claimable for that proportion that you use that property for personal reasons or not have it available. And just be very careful because, you know, the ATO understands that, you know, some people might tell their real estate agent, you know, don't put it on the books this month, so I'll use it, but say it's available. So the ATO looks at those sorts of things as part and parcel of their reviews.
I guess they're also looking at if you're renting out part of your home, Ken.
Yep. And that has two penalties, because if you're renting out part of your home, you proportionately lose part of the main residence exemption. And the main residence exemption is what gives you the zero tax on the sale of a family home. So you would lose it proportionately. And it's funny, I was talking to a client just the other day, and they were saying, oh, but I'm only renting off one of the small bedrooms. You know, it was a 2-bedroom place. And that only accounts for maybe 20% of the floor area. And I said, yes, but they use 50% of the bathroom, 50% of the family room, 50% of the kitchen. So the weighted average, it becomes much, much higher than just the room you rent out.
Now, isn't that interesting? Now, some people are going to be listening to this and saying, is Ken an accountant? And the answer is, yes, you are, but you don't do accounts and you don't do tax. I don't think you even do it for your kids anymore. But you actually give high-end advice, strategic advice to your clients at Metropole Wealth Advisory, Ken.
That's right. And through this working with clients, we've actually seen a lot of the more common errors. And when I was practicing in the accounting firm, then that was first-hand experience. So there's that first-hand experience and now working with clients. So one at an operational level and the other one at a strategic level.
And you've been an investor for many, many decades as well. So, Ken, what about when you own a property jointly with others, with your wife, with your husband? They may have a different tax bracket. I guess the taxman is wanting to make sure that you're correctly apportioning the rental income.
That's right. So if you're on contract 50-50, each person gets 50% of the income and 50% of the expenses. Now, one area that a lot of people do incorrectly, particularly if they were allowed to claim depreciation on the fixtures and fittings, they only get one depreciation schedule. So we tell people to do a split depreciation schedule because you normally can get a much higher annual deduction, at least in the first few years. The other big mistake I see is the higher income earner purchases the investment property to get the higher tax benefits, but the loan is in both spouses' name or both partners' names. You can only claim then half the interest if you're the owner because you only have half the debt. The ATO is quite strict on that, and I think we'll be looking more and more at that. And that's just a function of serviceability, that the bank wants a second person on the loan to increase the serviceability. But don't lose heart, that is fixable by simple documentation that you can put in place that will shift the tax burden back 100% to the person on the title.
Yeah, there's a lot more I want to discuss with you, but I think it's probably worth pointing out at this stage then that you can avoid some of these things by getting things right at the beginning and by documenting things correctly at the beginning. And that's part of what you and your team do with a strategic review at Metropole Wealth Advisory. So it's better to get advice before you do something.
Correct, because we often see people come in, and we were talking about repairs versus maintenance before. What would have normally been classified as a repairs and maintenance and therefore immediately deductible, if you do that at the beginning of the time when you buy a property before you get your first tenant, the ATO says, no, those rules don't count. We will now look at it as an improvement because what they argue is when you do that work, you'll get a better rent. So therefore, it's an improvement. Compared to doing the exact same work 6 months later after you've had a tenant. So you've got to do that right and get that, if you like, advice early on, because it's too late if you do it at the beginning incorrectly.
Sure. I think the other thing you've got to do is substantiate all your expenses. You've got to keep receipts. You've got to keep documentation. In the absence of proof, that ATO will just make it easy to just deny a deduction.
That's right. And the simple ones are, really for people using their car, you either do the logbook or you do the kilometres. And if you do the kilometres, 5,000 kilometres, people say, I'll just say I did 3,500 kilometres or whatever the number is and claim the cents per kilometre. The ATO can ask you to substantiate that. When did you do the kilometres? What was the purpose of the trip? So there's a lot of work there. The other big area that people miss out on is this claiming the $300 for work-related expenses. People think it's an automatic gift of, I get a $300 deduction. But again, you have to have substantiation of spending that money. They just make it a bit easier to say, we'll assume that you can have 300 if you can support it. And the other big one that I think a lot of people ignore is fringe benefits tax. So, your employer is allowed to give you an infrequent and as a surprise, a gift up to $300. And that doesn't attract fringe benefits tax. So there's a bit of scope there for an employer to show a little bit of thank you to employees on an occasional but unexpected basis.
Now, if we read between the lines, I'm an employee of a number of my own companies, so I'm actually allowed to get those benefits as long as I don't expect them, as long as they're done in the correct sort of way. So one can think a little bit creatively, but of course don't take anything too far. Getting back to car expenses, because you mentioned it a while ago, the tax department changed things a while ago. As a property investor, can one claim car expenses or travelling expenses to go and look at your investment property to see how it goes?
Yeah, so you can no longer claim inspection costs, which takes into account travel. Typically people would say, if I own an investment property in another state, I'll go and inspect it and maybe apportion it between work-related to see the investment versus the holiday. But now it's zero. But depending on the structure you've bought the investment property, some structures allow you to claim those travel expenses. But for the majority of people, they cannot claim it because it's in a structure that the ATO won't approve that expenditure. So again, when you're deciding which structure to buy a property, then you've got to look at a whole bunch of issues, land tax being one, deductibility, flexibility, asset protection, and then come up with the best structure to, if you like, meet your future objectives.
So that's, again, something you've got to do right at the beginning, and we keep coming back to getting the right advice and investing in yourself before you actually go off and buy an investment property or start a business or a new joint venture. Make sure that you invest in just getting it all right. It's too hard to unravel later on. So work-related expenses is another area that you started to touch on a little bit. The ATO's definitely identified a lot of dodgy work-related things, including, well, we said cars is one thing. It depends what your job is. Clearly, you can, if you've got a job that requires you going from one place to another, but you can't claim the first part of your car trip either, can you? Because I guess you suggested that you've got to get to your workplace in the first place.
That's private. So unless you're carrying hazardous or heavy materials and you need that car, then that first portion would not be deductible. So, you can't take the two big tool bags on the bus, so to speak.
Yeah.
You need the ute or whatever. So there is some flexibility there. You've just got to be very careful then that the use of space in your home, and if we look at consumables, so the electricity, the heating, et cetera, you can claim that. But if it's your home that you own, even though you might be paying it off, if you claim part of the interest or the expenses for owning that property, then you lose part of the main residence exemption. But if you rent, and you rent a property, with an extra bedroom, with an external entry, so people can come to your office, then you can claim part of the rental as part of your business costs, the same as you could if you rented any other property. But again, you've got to meet the criteria. But the big difference is if it's your home, you probably can't claim any of the occupancy expenses, whether if it's a rental property, you probably can within the limits of the law.
What about phone and internet costs and things like that? I'm actually running my own little business. I'm working from home. What can I claim?
Look, in the main, you can claim all of it or most of it if it is predominantly for business. I mean, if you're a plumber who could be on call at any time, you got to have your phone. Yeah. And if you infrequently use it for personal reasons, then, that's just part and parcel of having a business phone. The same as if you're in the office, you might use the phone in your employer, to ring up home.
Sure.
So if it's substantially disproportionate, so, a big chunk is private versus business, then you have to apportion it. Or
sense.
Like some of our clients increase the speed of their internet service because they need it for work. So if it was just home use, they could have a lower speed service, but for business, they have to have a bigger one. So those extra costs then push the weighting back towards business.
Now, I know this year the ATO has got crypto investors in their crosshairs. In fact, there seems to be a very large percentage of the millennials who are, I was going to say investing in crypto, but Ken, in my mind, they're speculating. I am having real difficulty understanding what's going on. But having said that, the ATO's put a huge effort into understanding what's going on over the last year or two.
Yeah, because a lot of the crypto trading is done behind the curtain, so to speak, because it doesn't go through your bank account per se. So when the bank sends information about your bank account, that won't be there. But if all of a sudden you deposit 100,000 into your bank account, then that raises a whole bunch of questions under the Anti-Money Laundering or Terrorism Act that, they can ask you questions of anything over 10 grand. So there are, if you like, alternative pathways that the ATO can start sniffing around and seeing what you do. So you've got to claim, and you've got to decide whether you're a trader or an investor, because you can still invest, and then when you sell, you get the 50% discount. But if you're a trader, you're doing it often, it's your business, then it's normal income tax.
Sure. So the ATO is looking at, apparently there's at least 500,000 and maybe 1 million crypto owners in Australia. And it's actually, as you said, with this data matching, getting it from the prominent exchanges to capture everybody. In other words, if you're hoping to hide your crypto, you're likely to get caught out. So declare it. And again, as you said, are you an investor or are you a trader? Because if you're a trader, there's you just got to pay tax on it. The other area that the tax man's looking at, Ken, is the sharing economy, the gig economy, there's a lot more of that happening, whether it's ride sharing with Uber or Didi or whatever, or Airbnb or Airtasker. It recognises this is happening, and it's not going to let people get away with hiding this.
And I think they've gone one step further. They've actually put in place mechanisms for those initial service providers, the platforms, to actually send the data to the ATO. I've got these properties on my books, and this is the revenue that we've collected it. So they can trace it back to the owner. They know who the Uber driver is. They know all that. So data matching is going to be very easy. But the ATO has also got a big ace up their sleeve when tracking, have you appropriately declared income? And I'll call it by its own name. It's called the income betterment test. If they're suspicious of you, they can come to your home, your workplace, whatever, and put a value on everything they see. And if they say, this house would cost, $1 million to own, but you're only showing 50 grand a year income, how did you afford it? So they look at your assets and your liabilities and your income to see if they match.
So I guess part of the message amongst all this is don't get yourself into trouble. The penalties are too big, but there are ways, if you get the correct advice and get it early enough, to legally minimise your tax. Ken, they're also looking at super contributions, aren't they?
Yep. So now that they've made it easier for people to make, they call it concessional contribution. That's the contributions that are taxed at 15% when it goes into super. So there's three ways to put concessional contributions into super. Your super guarantee, that's what you'll get taken out of your wages, salary sacrifice, and what you decide to put in. So all those have to be supported by the correct ATO application form. So the ATO knows that you've done it prior to year end when you say you've done it. One of the big errors that people make when they're putting in top-ups, because you're allowed this year, call it 27,500, but that's over the full year. And your employer is not legally required to put in the super contribution every week when they pay you. They could put it in 3 months later. So last year, they might have put in last year's at the beginning of this year. So all of a sudden, you've gone over your 27,500. So you've got to be careful to see what has hit your account in that financial year, not what was supposed to hit it. And that's a big trap because it's now not taxed at 15%. They'll treat it as after-tax money and tax you at your marginal tax rates.
Now, I know another thing that some baby boomers are doing is downsizing their home. They actually have got some money left over and they're putting it into super. The government's actually been encouraging people to do this. I guess what they're hoping is they don't have to pay as much pensions down the track. What's the situation with this?
So they've reduced the age from 65, you had to be over 65, to 60. You must have owned the property and you didn't have to live in it the full length of the time. You just had to be living in it at the time you sold it. And each person can put in 300,000. So a couple, a spouse, a married, de facto can put in 600,000. And that 600 is not capped in relation to the normal concessions. So normally you can only put in 110,000 a year of after-tax money, and there's limitations based on your age and things like that. So the downsizing is outside of all that. But the trap that a lot of people fail or fall into is the money must be paid in within 90 days of settlement. If it's not paid within 90 days, you can't use that benefit. So luckily it's settlement and not exchange, but you just got to be a bit careful, particularly if you're looking to use part of the money on the next home and you may not be quite sure how much you're going to have left over.
Now, one last area I'd like to talk about is I know some people have done some tax planning, like at this time of the year, before the end of the financial year. And hey, look, I know I've got to pay interest next year. What if I pay it now, bring forward some expenses or some prepayments into this tax year to mean I pay less tax at the moment? Is that allowable?
Yep, within the rules. So you can only prepay what you know you have to pay in the following year. So you've got a rates notice, and a lot of people pay it off quarterly, but you know what the full year's amount is, so you can prepay it and get a deduction. Your interest, you've got to be very careful, because if you're on a variable interest rate, you don't know next year's total interest rate. So you can't pay that. So you can only prepay it if it's fixed interest, because then you know the amount. The other big thing with borrowing expenses that we see a lot of people forget is borrowing expenses. So you can normally write them off over 5 years or the life of the loan. So, particularly lenders, mortgage insurance, those sorts of things. So if you refinance or sell that property and move to another property, call it 3 years after you've set up that loan, you can write off the balance immediately. So it's 5 years or the length of the loan. So we see a lot of people losing out, if you like, claiming that last bit. They're the main ones that of substance. The big one is obviously using an investment property for personal reasons, claiming part of home office. If you're renting part of your home, it reduces your main residence exemption. You've got to put in all your income, because the ATO now is getting smarter and smarter, and they have more and more tools to identify people who may not be declaring everything.
So there's lots of things the taxman's looking for, but what happens if it finds that you've made a mistake, on purpose or not? And a lot of people are not doing this on purpose to cheat, but just they don't understand the rules. What are the penalties?
Well, the penalties can be quite severe. They're certainly 25 to 75%, but in some instances up to 95%.
25 to 75% on
of
top?
The tax.
Yeah,
that
on
you
top.
didn't, on top. And it can be as high as 95%. And that really opens the door for them to go back and have a look at easily the last 2 years. And if they're suspicious about, whether you were fraudulent, did you do it on purpose, they've actually got the mechanism to go back 4 years. So that's quite a hefty penalty. And it normally happens with a please explain letter.
Yeah.
So I think that is your first opportunity to have a good hard look at, did you miss out anything? Even if they didn't ask it in that first letter, and come clean.
Yep.
Because if you come clean before they send in the auditors, so to speak, then the penalty rates tend to be at the much lower amount. But if you resist, then you don't sort of divulge everything, that's when the penalty rates, the penalty percentage goes up. But on top of the additional penalty tax, they charge you interest on the money they didn't get off you.
So it really adds up.
At a penalty rate. So it can add up quite considerably, yes.
It can. So I know I've protected myself by doing the right thing, by having the right documentation, by getting the right advice. But Ken, I've had a number of audits. They've all actually gone fine, but it's actually emotionally draining and it's quite expensive. So I've covered myself by income tax audit insurance as well.
Yeah, that's a very good idea. So I think people in business, people who've got self-managed super funds particularly, should have audit insurance. You organise that through your accountant in the majority of cases. And yes, you still have the heartache, but at least the costs are covered in the majority of cases. So for normal mums and dads, that may not be appropriate. But, if you've got 5, 10, 15 investment properties, then, there's a bigger mirror for you to look into and a bigger microscope for the ATO to look down. So I would even countenance audit insurance once you've got significant business assets, and property should be considered as a business, particularly, even one, is a business, let alone 5, 6, 7, 8.
Sure. So I hope that this discussion has helped the person listening to us today, Ken, become aware of some things that maybe they're not doing to protect themselves, and get advice from your accountant or from the team at Metropole Wealth Advisory. Now, Ken, I know that you provide tailored strategic wealth advice for high net worth individuals and their families, professionals and business owners. Maybe just quickly you could explain why somebody should use you rather than go to their accountant.
Yep. So when you go to your accountant, you're really looking at one focused thing. And from a practitioner who's looking at operational issues, very few accountants look strategically. But when you're talking about wealth, when you're trying to grow, protect, and pass on that wealth, you need to have a look at a wider gambit of items, such as, is your structures right? Is my risk management in place? Is my estate planning done correctly? Have I got the right structures, business versus investment? Do I need to restructure? Because in a lot of instances, 5, 10, 15 years later, circumstances change, and what may have been appropriate is no longer. So we start off with a forensic review of everything, and we then can actually talk to those other professionals because we speak their language, either the estate lawyer or the financial planner or the accountant, to actually look at the whole thing holistically and make sure each piece of that wealth creation plan works. And it's focusing on that word plan. You need a plan, knowing what you're doing, how you're doing it, and where it's leading you to, so that you can have periodic, if you like, reviews to make sure you're still on track.
Sure. So basically, you're looking at helping people grow, as you said, protect and pass on their wealth, fix problems. But I think also the big thing you're doing is helping people avoid problems. You've seen the landmines. And just with the discussion we had today, it's going to create a lot less anxiety if you know you've got everything covered. You're going to be able to sleep at night. So when I actually, at the end of last year, I've told you, I got a letter from the taxman saying they're going to look at me again, and I'm still waiting for them to. I'm sleeping really well at night. I've got no issue about it. I know that there's nothing they're going to find, Ken.
That's it. So it's that peace of mind. And it's, I think, like you're going to the dentist, you're apprehensive to go to a dentist, but, the ATO is a different thing because, they've got untold resources, and, if they get a bee in their bonnet, they're going to pursue it.
They will. So if people want to find out more about what you and your team do, I'll be leaving a link in the show notes, but go to Metropole and look at the Wealth Advisory tab. And Ken, thank you very much. We'll be back for our regular monthly chat real soon.
Thank you, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
My mindset message to you today is that you're a miracle. There are roughly 7.7 billion people in the world today. Imagine the world's biggest lottery in which every one of us is required to draw a ticket with the circumstances that we're going to be required to live in for the rest of our lives. For example, are you going to be male? Are you going to be female? Which country are you going to be born in? What type of government are you going to have to suffer? What are your parents' income levels? What are their occupation? What's your IQ going to be? Remember, you're going to draw a lottery ticket that's going to tell you what your life's going to be like. Your height, your weight, your eye colour, your hair colour, your body type. It's going to tell you what your personality traits are, your temperament, your wit, your sense of humour, the level of your health. Now, if you're listening to this, I'm guessing you drew a ticket when you were born that wasn't too bad. The probability of you drawing a ticket that has the favourable circumstances you're in right now is incredibly small. In fact, I've read that the probability of you even existing comes out to 1 in something followed by 2 million zeros. I don't fully understand how they work that out, but the chance of you being alive, being who you are, I guess then means basically zero. In other words, you're a miracle. Warren Buffett often talks about how grateful we should be for all the circumstances we're born into. and the generous ticket we've been offered in life. He says we shouldn't take it for granted or think that it's the product of something we did personally. We just drew a lucky ticket. He points out that his skill of allocating capital would be totally useless if he'd been born into poverty or at the time of the American Civil War. Yet most of us are too quick to complain about the traffic on the way to work, or the weather that's going to spoil the sport or the weekend, or ungrateful clients that you've got, or customers that you've got, or your boss, or people we've got to deal with. I guess many of us suffer a self-entitlement syndrome. Entitlement gets us nothing but heartache. It blinds us from the magic of gratitude. And you've heard me talk about gratitude before. And most of all, entitlement lets us off the hook, pushes us away from taking responsibility and action and towards apportioning blame, anger and self-pity. On the other hand, gratitude, that's just as valid a choice, except that gratitude makes us open to possibilities. It brings us closer to others. It makes us happier. So I want to finish this mindset message with a simple life hack. You're not grateful because you're happy. You're going to be happy because you're grateful. I hope my chat with Ken Rais about the taxman coming after you didn't scare you off too much. I hope that we gave you some information to help protect you. And if you've got some benefit and you know somebody else who'd get benefit from this type of information, please do them a favour and tell them about the Michael Yardney podcast. And you'd be doing me a favour in my quest to make as many people as possible financially fluent, to help them work their way up the ladder. I'll be back again real soon. You can catch me in between each episode on social media. Just look for Michael Yardney, or in Facebook, have a look at the Property Update private Facebook group where you can get some information from me. Each day I leave a little tip or some information. Property Update, a private Facebook group. Now, as a way of saying thank you, if you haven't already downloaded them, go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au. I've got a group of ebooks and reports, my way of saying thank you for subscribing to this podcast. And as I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?